The biggest misunderstanding of closed-end funds, I think if they look at a yield, and which is very attractive, is high, and they don't ask many more questions, they may be disappointed, especially in the short run, when the markets go down, and if there's leverage, that may exaggerate that, and the discount may widen. That would be not a very pleasant experience. So again, asking a lot of questions. What's in the portfolio? What kind of exposure is there? Is there leverage? If so, how much? The cost of borrowing, is that floating? Is that fixed? How much of it is fixed? The distribution, is the distribution too high perhaps? That is not sustainable. In some cases, some closed-end funds do pay more than what they're making, what the NAV total return is. So you want to try to avoid that. Some misunderstandings are among return of capital. We think return of capital is not necessarily always bad, but you need to understand, is this return of capital? We try to differentiate between the destructive and the constructive return of capital. Destructive is easy to explain. Basically, if the distribution is too high compared to the total return that the portfolio can produce, then the NAV is going to erode. So that would not be desirable. Constructive return of capital is mainly due to tax issues, but as long as the distribution is reasonable and sustainable, then we think return of capital is not a bad thing. There are a number of publications out there. There are a number of websites out there. The CEFA website is definitely a wonderful tool, probably the premier objective website that provides information. It even links a number of reports from the fund sponsors, from analysts like myself, that can educate investors on how closed-end funds work. Not only that, they provide data as well. Another fabulous website is CEFconnect.com that provides a lot of data, great data that one can use. You need to figure out what is the key data to look into. So once you know that, CEFconnect.com will provide that information for free. Anybody can access it. You don't even need to register anything. It's right out there. So that's very useful. In addition to that, I'm sure there's a few books. There are not too many of us, but there's a few analysts, closed-end fund analysts out there that is definitely a resource for the financial advisors to educate and to access that knowledge and to understand what's going on, what are the trends, what are some of the factors that we look at for closed-end funds that are favorable, and which ones are the ones that we try to stay away from. There are a number of factors that we look at when analyzing the closed-end funds for our select list or for our avoid list. Unfortunately, I feel that out there's a number of sources, a number of people that may focus simply on the discount and just look at the discount, favor the widest discounts. And that is a factor. It is important. I think it's not the most important factor. There are a number of other factors that I believe one should also focus on. So for example, the stability of the distribution. We don't really care for a closed-end fund with a double-digit discount if we think the distribution will be reduced by 20%, because that discount could widen further. So the stability of the distribution, we spend a lot of time looking at that. Then the liquidity, we tend to favor those funds with more liquidity. There is some kind of a correlation between asset size and liquidity. Having said that, there are a few closed-end funds that meet all of the requirements and are less liquid, but one would need to be much more careful trading such a closed-end fund. There are certain guidelines, best practices that we tell our financial advisors. to follow. So for example, try not to be more than 10%. The position should not be more than 10% of the average daily trading volume. Pay attention to the average daily trading volume. They're not like ETFs where they can always create and redeem. Here the number of shares outstanding is limited, so you have to be careful. You can't just try to buy a lot of a closed-end fund that is very thinly traded. Every once in a while we get that question, oh, my client wants to invest $1 million in this closed-end fund, and we tell them, no, just be careful, or maybe there's a few more funds that you want to diversify to avoid moving the market. So you have to be careful with that.
Absolutely.
Another thing is make sure that that investors understand what's in the portfolio. In fact, I was at a conference recently, and somebody in the audience, one of the panelists was talking about REIT closed-end funds, or closed-end fund that invested in REITs, and somebody in the audience asked, so do you invest in the real estate or in the debt? And so there was not a complete understanding of what is the exposure of the portfolio really. So that's probably the number one question I would say somebody should ask to fully understand the portfolio, the exposure of the portfolio. One of the benefits, in my opinion, of closed-end funds is the fact that they can use leverage. And that certainly brings additional risk with it. The NAV and therefore the price is likely going to be more volatile on the way up, which is great, on the way down, which is not so great. But it does allow investors, if they're very yield focused, very income focused, to select a structure such as a closed-end fund where they are allowed to receive much more cash flow. Even if short rates rise, which would mean the cost of borrowing is rising, which may mean the distribution comes down, even after such a dividend cut, the yield that an investor may get is probably going to be very attractive compared to what they may be able to achieve either in the individual bonds or with an ETF or with a mutual fund that may not leverage. In addition to that, the closed-end fund, because of its closed structure, would be able to not worry about redemptions, which means they can invest in certain securities that are less liquid but higher yielding, higher return. So all that, I think, are benefits of the closed-end fund structure in all sorts of different asset classes. In the recent past, in the past year, I think a lot of questions have come about leverage as investors see the short interest rates rising. They're concerned about what that may do to the distribution. And sure, we've seen already some dividend cuts, and if short rates continue to rise, one could expect that in many cases we'll continue to see some dividend cuts. As long as short interest rates don't rise, don't spike tremendously, chances are, even after dividend cuts, the yields are going to be quite interesting, and the spread between the cost of borrowing and the rate at which the closed-end fund can invest is still going to be wide. And so therefore there is the advantage of that higher yield. And longer term, that spread is usually very positive, is advantageous. So if you look long term, leverage is additive. Sure, you're going to have to short term sometimes go through a little bit of more volatility. But as long as you're willing to take short-term pain for long-term gain, that seems to be an advantage for the closed-end fund investor.
Any other thoughts?
Any other thoughts? Make sure that you know what you're getting into. I guess this is for closed-end funds and for any other instrument, to understand truly what you're getting into. With closed-end funds, you have a few more moving parts. So make sure you have the leverage, you have the discounts. The discount could narrow, the discount could widen. So you have a few more moving parts. Make sure that you understand that very well. That will probably mean that you don't have any surprises going forward, and if there's no surprises, even if the market goes down, the leverage exaggerates that. That is not understandable, but that is not going to be a surprise, and so therefore it will be a better experience.